Oh my God, I can't believe this was. Oh.
All right.
Yes. Well,
Okay. All right. Happy Friday. Here we go. So here's median price. So we were up 3.5% last month. So 415. And remember, when you're doing the monthly, this is compared to last September. So this is compared to 1 year ago. So up 3.5, which was a little surprising to me that we're having that bump. I still think it's related probably to all the new construction closings for the fiscal year. So up a little bit higher here, but kind of flat over the last, almost coming up on 2 years. And one way to look at the trend is let's get rid of some of the seasonality, just go to the 12 months. So you really can see it here. So a rolling 12-month average, we've been around 400 for, a little bit over a year. Up a little bit still, but fairly flat, especially compared to this period here. Obviously, a lot of this is interest rate driven, just from an affordability standpoint. So as we watch this move forward, I think we'll see this fall off in the winter like we typically do. Probably go below 400 is my guess, but fairly sideways movement, I think, until rates kind of settle down, not go down, but until they settle down, I don't think price is really going to go anywhere as a whole entity here. Something's wrong with Market Monitor on their previously owned, so the data is not displaying for some reason, so we can't break them up separately other than the new construction's off 3.4%. I thought this was a little interesting that new construction prices are down over the year, which means if the previously owned works, that means prices were up for previously owned if the whole is up 3.5. So we're not going to break apart new construction and resales just because the resales are not working correctly in Market Monitor. We'll skip price per square foot. I think we'll go through it quickly. It's up. I think that's due to the cost of construction, and people renovating houses. So it's at a high. So I think that's a lot of what's
John.
Hey John, you're on the phone. So this is going up higher because I think of the new construction. The drive of that is driving prices up. Percent of original list price. I mean, this is not surprising again as you go into the winter. You're going to see this start to fall off. I mean, this is the COVID period here where we were stuck at 100% on median price, and then we fell off when interest rates went up. Look what happened. We fell off all the way till January. This is a combination of interest rates and seasonality. This is the new year seasonality, and now we're back to the slower part of the seasonality. So expect this to continue to go down, which means buyers are getting a little bit more negotiating room, and sellers having to negotiate. And if we go back in time, remember, if we go back in time, let's take 2014 to 19. If we're at 98%, that's kind of the normal range. So this is not surprising. The volatility here reminds me of volatility back here. When we were kind of trying to figure out after the recession, there was a lot of change in negotiating. We're just at a much higher level here. Let's zoom in a little bit. So if we go to days on market, if we look at here, we're at 10. Remember, this is median. So 10 days. So this is the best way to handle this with your buyers or sellers. If the median is 10, that means half the houses are selling within 10 days. Right? So median is half the houses sell within 10 days. So if you have a seller, the expectation up front should be if you are priced correctly, you will sell within 10 days. And it's kind of preempting, if they're not selling within 10 days, you need to make sure up front, it's like if it's not selling within 10, the market is saying that you're priced too high. So, again, this is starting to go up, which again is seasonality. We're going to go up into the winter months like we did prior to COVID. You can see the seasonality. So if you take 2018 as an example, we were at 30 days in January, we went down to 14 and right back up to 34 in February. So here's the seasonality that you can see finally we are returning to some level of seasonality. You know, we lost it for a couple years with COVID, but now you can see this curve starting to form again. So expect this as you go in, and this is conversations with both sellers and buyers right now. Your sellers are heading into the harder part of the year on a seasonality to sell. So it might take longer to sell their houses, and they just need to realize that part of it is like the 10, we could go to 25 here in a few months. So it might take a month to sell the houses as a median. And conversely, with buyers, it's the buyers have more opportunities now because there should be less demand on the seasonality. So, you know, again, all these numbers apply to buyers and sellers. It just depends on who you're working with and your conversation with them. Months of supply. So months of supply, we're at 2 months, which again, historically is well below, you know, the normal 4 months we were in pre-COVID. And I did see, you know, NAR was saying we need to double our inventory in order to get back to a normal market. This is basically what they're saying. You know, if we had the same number of buyers every month and we double our inventory, we're going to go from 2 months to 4 months. So that's what they're saying. This is the normal period here. So if the inventory doubles, we'll go from 2 to 4. And then that should, you know, get back to where you have, you know, remember back in 2018-19, we didn't necessarily have multiple offers and, you know, as frequently as we do today. And houses were taking 20 to 30 days to sell. So we are starting, you know, 2 months. We hit 2.1 last October with the high rates. Remember, this was rate driven here. I mean, we're starting to get into the seasonality and the rate driven. I read yesterday the 30-year mortgage rate on average is 7.49%. So that's the highest in 22 years. So, you know, we're pushing, the rates are pushing this higher, you know, at the same time. So keep an eye on months of supply over time. Homes for sale. So again, with Market Monitor, it says down 11.4%, but if I look at my calendar on my wall, we have the same number as we did last year. So we are sitting right about the same inventory. So my perspective was we're 0 from an actual calendar count. So we're fairly flat on inventory. But what's interesting is the high last in 2022, the high was November, in the seasonality part was November 14th. Right. And then it fell off because of the holidays. Right. And the holidays do 2 things. One, people take it off the market because they don't want to be showing during the holidays. 2 is they don't list during the holidays because they don't want to show the house during the holidays. So this inventory, if it follows last year, you know, here in another couple of weeks, you're going to watch this inventory start to go back down. You know, in last year, it went down about 10%. So, you know, this inventory could go back down from 2,900, maybe back down to 2,700. So, you know, rates play into that. There's a lot of things that play into that, but on a seasonality basis, we can expect it to kind of start to decline, you know, because of the seasonality. And I'm going to spend some time on these closed sales here. So this is really what matters to us, right? How many transactions are we doing? So here we go. So if we're off 12.3% year over year, right? But if we look at the rolling, so the past 12-month period from this month, we're off 21.8. So the good news is if we look at monthly, if we're off 12.3, but on an annual basis, we're off 21.8, that means our decline is slowing down. Right. And if our decline is slowing down, you can see it a little bit in the chart here. It's like we're trying to find a bottom. You know, 7.58% interest rates might come into play and drive us a little bit lower. But there was a lot of things I wanted to share on this chart. So if we go back, as far as Market Monitor goes back, we're at 17,000 for September on a 12-month basis, right? So 17,000. The last time we were at 17,000 or below 17,000, you got to go back to July of 2016. So last month was the same pace as 7 years ago, right? So I'm just trying to put perspective. The pace that we were at June of 2021, we're off 32% from this pace to where we were last month. And again, you can see in the curve, I mean, maybe we haven't bottomed out yet, you know, and obviously interest rates and everything else in the world plays into this, but I think we're going to bottom out in the first quarter. So we're in the process of trying to find this bottom, but you can see the bottom is about where we were 7 years ago. And I also want to put perspective, the 17,000 in February of 2006, the past 12 months, we had closed 18,000. So we're actually at a slower pace on transaction count as we were 17 years ago, 17 and a half years ago. So, you know, and if you look at what I look through is like, okay, well, this was the peak. Here was the low was August of 2009. So we only closed 7,715. So we're almost 10,000 more than we were at the low of the recession. But one thing I did is I pulled up the NAR numbers because I wanted some perspective here. So back when I started in 2001, there were 766,000 members. Anybody know how many NAR members today? So as of September, there were 1.578 million NAR members. So, and I can't go here on the chart, but in 2000, there were 766,000. The peak count for this cycle was actually 1.357, 1.35 roughly million members. So not quite double, but the peak actually happened. Sorry, I'm just looking at my numbers here. The peak happened in 2007. So actually the end of 2007 was the peak. So what do you notice about transaction count and agent count? So there's like a 2-year time lag between the time you see the peak transaction count and you see the peak agent count, right? So February of 2006 was the peak transaction count, whereas the end of 2007 was the peak agent count, right? So a 2-year time lag. So let's fast forward here. The bottom of transaction count was roughly the middle of 2009, right? So we had 7,700 transactions. The low in agent count on NAR numbers was actually 2012. So in this range here. So that's almost a 3-year time lag from the bottom to when we reach the bottom of agent count. So, I mean, we're dealing with a 24 to 36 month lag between transactions and agents. So we're going to fast forward to where we are today. And if I look at 2020, so the peak transaction count was June of 2021. So how long ago is that now? It feels like forever ago, doesn't it? So that's 2 years and 3 months ago, right? So that was the peak agent count. Sorry, the peak transaction count. If I look at where we are in NAR, in 2022, we finished with 1.58 million agents. So right in here, we had 1.58. If I look at September numbers per their website, we're at 1.578. So we're basically forming a bottom or a top on agent count. So we are 2 to 3 years past this peak transaction count. What's about to happen to agent count? It's about to go the other way, right? So history tells us a 2 to 3 year time lag. So now we're about to bottom at the same time the agent count is about to fall off, right? How much it falls off, I don't know. You know, last time, if you look at back here, yeah, we went from 18,000 transactions down to 7,700. We're not going from 25,000 down much more than where we're at right now. So we've lost 32% of our transaction count from here to here, right? So we lost 32%. here we lost, let me just do some quick math. So we lost minus 7715. So we lost 57%. So we lost 57% of our transactions. We've lost 32, and it appears we're trying to find the bottom, right? We're close to it, maybe the first quarter. So the agent count, when we were back here, from the peak to the bottom, we lost 26% of the agents, right? So we lost 26% of the agents from the peak, which actually was in here, to about here. So how many agents are we going to lose? I mean, if we lost 57% back here and we've lost 32% here, I mean, do we lose 20 to 25% of the agents? I think so, right? I think it's possible. So if we're peaking out on agent count and it looks like we're turning around, you know, that 1.58 million agents, in a couple years, we could have 1.25. So all I'm saying is that if you focus on moving forward and keeping your business going, you can be the beneficiary of two things happening at the same time, right? Transaction count is going to bottom and it's going to start to go up. At the same time, the agent count is starting to go down. So you've got two benefits right now for being an agent, is that you're gonna see the benefit by default of less competition from agents. At the same time, your transactions are going to start to return at some point. So that's why this was such a great period of time to be a real estate agent, right in here, because transaction count was going up. At the same time, agent count was going down. My best year was from here to here. So 2013 was my best year, and it's because the volume of business in the areas I worked went up 50%. Whereas what agent count was actually, and I'm looking at the chart, agent count had just leveled off at the bottom. So you had almost no new competition with a huge increase in volume. So at what point are we going to reach that now? Jan's saying, I also think we're going to have an increase in agent retirement. You're correct, Jan. Like when you and I got in the business, we're looking at a lot of those agents that were the experienced agents when we got in the business they're basically done, right? They're getting out of the business. You know, they're either putting in a referral, they're moving to a retirement, you know, a different area of the country for retirement. Yeah, and exactly, particularly those that have recovered from their losses in 2007. So you're totally correct there. So where you're at as an agent is that take advantage of where we're headed. Yeah, it's not the easiest business to be in right now, but the ones that survive it are going to take advantage, like we did back in here, of these years. And I was running some numbers with John earlier. So from the bottom of the transaction count to right about here, where we seem to have leveled out, right, on transaction count, the market recovered 8% a year. Oh, sorry, 11% a year. So 11% a year from here to get back to here. So if we bottom out on transaction count, can we go back up 8 to 10% a year in transactions? I think so. You know, at some point we're going to recover. Now, if you add from this, maybe we over improved from here to here, and that's why you saw this flatten out. But even from here to here is still 8%. Right. So I feel like that 6 to 8% should be very doable once we find the bottom, which I think we are going to find. But don't think 2024 is going to look like this. It's not. Right. It's like if we can level out the first quarter and start going back up at 6 to 8% a year, it will still take a few years to get back here. But the combination of that agent count decline, and if it's 6 to 8% a year, and so think about it. If you're an agent count was sitting completely flat, and the transaction count went up 8%, and you were an average agent, your business should go up by 8% by default. Well, if agent count is going down by 5 to 10% and volume or transaction count goes up 10%, you can start taking a whole lot more transactions and volume as we go forward. So, I know I spent a lot of time on this one, but this is so important for perspective and history of, what happened back here. And the agent count really started to increase when you had this, but it is a 2 to 3 year time lag for, for transaction count to affect agent count. And obviously we're right about, we're 2 years and 3 months from the peak here. So that's what we're starting to see. And I'll try to keep track of this, maybe not on a monthly basis, but watch what the NAR numbers do, because right now we're showing slightly less agents than we did at the end of 2022. And I expect by the time dues are due on December 31st, this number is going to drop, right? So we have that June cycle and the December cycle, but I expect these numbers to start to drop at some point. All right, let's get any questions on that topic specifically. All right, so let's go to on new listings. If we look at new listings here, and I'm going to go back and zoom in a little bit. So new listings. So when we look, we're off 3.1% from a year ago. And if you look, this is the first year. So this is pre-COVID, right? Here's 18, here's 19, here's 20, 21, 22. If you start before 23, it looks pretty similar, doesn't it? Your peaks are about the same. Your trough is actually higher here, but it looks similar. This is the first year of the past 5 years that did not ever peak out at this number here, right? I mean, look at our peaks here. We're 2,600, 2,600, 2,559, 2,597, 2,561, right? Our peak month was actually March at 2122. So we never got close to where we were hitting prior to this year. And that's reflecting in, agents' business, but also if you look at the transaction count, you can't have a transaction without a seller. And we've kind of lost a percentage of sellers, right? From the 2,000 level to 2,500 level, we lost them this year. Now, the good news is if you look at this, so monthly, we're off 3.1%. If you look at a rolling 12 months, we're off 14.5. And you can see the last 3 months, again, I want a couple more months to see what happens. But remember, if we go to 12 months, that gets rid of seasonality. But the last 3 months, we seem to have gone sideways, which is this forming a bottom? I think so. I think we're trying to form a bottom here on listing count. So once we form this bottom, and you can tell not just from the visual, but also if we were 14.5% on an annual basis and we're only 3.1, we're getting closer to zero, right? When you start hitting zero, technically that's a bottom, right? When you're going negative to zero, that's a bottom. So we're getting close, and I'm willing to say it's like, okay, the next few months, we're going to see bottoms on a lot of these things. And part of the reason why I'm saying that is check out pending sales. Pending sales is already bottomed, right? So we're up 4.6%. So we've gone from negative, and if you do the rolling 12 months, it's negative, right? So it's a negative 16 if you look at 12 months, but if you look at 1 month, it's actually positive. So that's a sign that we're flipping that over to being, past our bottom. And I wanted to show you, you can see here, like this last little upward tick, right? And slightly higher here. It's like if we get rid of some of these months that we've had, this will start to turn around. Now, again, we're not going to wake up and all of a sudden in 6 months, we're back up here. That's not happening, right? So we have to be real that it's like this growth might be, start at 4% and go to 6% and go to 8%. But this is showing pending sales bottoming out. And what happens if you have in September, if you're up 4.6% on closed sales, what does that mean it's coming on pending sales? That means in a couple months, closed sales should be heading positive, at least to zero. Because remember, closed sales for 1 month are off 12.3, pending sales are up 4.6. So if we're up 4.6 and some of these start to close, this closed sales should get closer to 0 and flip around. So pending sales, again, is a leading indicator of what's coming our way. I know we have due diligence and a lot of things falling through, so that's something to keep in mind. But as this starts to go higher and positive, we can expect closed sales to do the same thing. Dollar volume. So dollar volume, we're off 3.2% from a year ago. Now, again, dollar volume, we didn't hit the 1.2 billion and 1.23 billion that we did a couple years. We were capping out a little over $1 billion. But if you look at it off 3.2%, if we do a rolling 12 months, it's off 18.2. But even this chart, you can see where the negative 3.2 is showing we're not quite at the bottom. We're getting there. And also perspective is the 12 months preceding September of this year, we did almost 10 billion in sales. That's way higher than we did back in here. We were doing 6.5 billion. So we are still way above where we were pre-COVID. Right? So yeah, we're not where we were in here. You know, we were averaging $1 billion a month. We're not there, but we're also not here. So, and it looks like we're trying to find a bottom. And again, if the pending sales do turn into closed sales, then we should find this. So, you know, when you look at the path, it's like, well, new listings has to bottom so that we can get some more product on the market to turn into pending sales, to turn into closed sales, right? So, and if you look at the lag, so, and this is 12 months, right? So let's start with the new listings. We're off 14.5%. Pending sales on a 12 months are off 16%, and closed sales, closed sales are off 21.8. So it's showing the new listings is the lowest decline. This is the next lowest, and this is next. So everything's trending the way we want it to get to a 0 and start to turn positive. It's just we need to get through, you know, this part of the seasonality. You know, we're going into the seasonality trend and we can't avoid it. So we got to get through the seasonality trend, you know, hopefully get to the point where we have stable interest rates, even if they're not going lower. And then, you know, get ready to flip the calendar, get some new listings on the market that will turn into pending sales and closed sales. Shows to pending. So again, this is, let me go back to monthly. So monthly, we're down to 8. So shows to pending, which is, it's saying, but historically, if you're in that 8, 9, 10 range, 11, you know, you're somewhere in there. So remember we said if you're 10 days on the market, that's your median. A good number to use is just use 10. You know, historically, use 10. So 10 days on the market, 10 showings. Like both of those are indicators of if you're being accepted by the market or not. So if you have a listing and you go through 10 showings and everybody has said no thanks, that's showing the market has said you're priced too high. If you go through 10 days, that's the same thing, right? So the 10 and 10 is a good rule of thumb to use pretty much no matter what year, you know, on the 10 showings. And if you look at your showings per listing, that's falling off, but that's falling off because that's the seasonality, right? And I mean, back here in the crazy moment, we had, you know, 11 showings per listing, and they all could have been the first day, right? 11 showings per listing, and now we're down to 5. But part of this is seasonality, and you can see the seasonality trends pre-COVID, and now we're starting to kind of get back to where we're going to go back then. But 4 showings, I mean, think about it. Back in 2019, 4 showings per listing per month. How many is that? That's 1 per week, right? So these sellers that have the expectation that 10 people are going to show up at their house the first weekend, it's not realistic at some point. That's not the market. Maybe that was the market for a moment, but that's not the normal market. And we're returning to a, you know, 5 is not that far off when we're back here. So if you're getting 1 to 2 showings a week, that's normal. You know, 10 showings in a day or 2 is not normal. So, you know, it's all perspective historically. And I know a lot of people tend to like forget what happened 3 years ago. because they were so used to the craziest moments of the market, but that's not where we're living right now. And you can see the drop off in closed sales from the peak. You know, if you draw a trend line, it's down. But again, if we're focusing on one chart, this is the one to focus on. It's like we need to find the bottom on closed sales, and I don't think we're quite there yet, but we're working on it. And once it reaches there, and I think part of what's happening is like next year is, whether it's the first quarter or second quarter, next year is to me a bottom of, you know, where we're going to form a base of, well, real estate's not going to slow down more than this on a transaction count, on a price point. You know, hopefully rates will peak out here in the next few months. You know, we keep hoping, you know, the rates will stop, but I mean, yesterday was a new high of 22 years. And, you know, unfortunately, this chart, it doesn't even go back 22 years. So I can't put a perspective, but I can tell you, I bought a house in Bell Hall in 2000, which is roughly 22 years ago, and it was 8.25. Right. So I truly believe, like, when they're saying we're at 22 years highs, like, yeah, my history in real estate is telling me, yeah, the 7.5%, 8% range is the 22-year high. Now, I mean, the jobs number came out today. You know, there's a lot of moving parts that are happening, but you got to keep in mind that the spread between the 10-year treasury, and now we're flipping to talk about interest rates because that's obviously driving our business on both the buyer and seller side. The spread between the 10-year treasury and mortgage rates, it is definitely at a, you know, at least recent history high, because that spread is usually 1.5 to 2 basis points or 200 basis points. So right now we're about 3% higher. So, you know, we are, there's some built in this 7.5% interest rate. I feel like there's at least 3/4 of a point or a point of that is built in of banks not wanting to loan money. You know, they're wanting to hold their assets, and sure, they'll loan you money at a really high rate, but for them to loan money at 6.5, they'd rather just hold it. Because, I mean, think about it. You can put your money in a money market right now and make 5% on it. So why are they going to take the risk of loaning money to a consumer at 6.5%? They're willing to do it at 7.5. They're just not willing to do it at 6.5. So, you know, there's a lot of moving parts in the commercial world of lending that could affect the banks, that could affect, you know, the residential side. There's no signs of stress in the residential side from, you know, a foreclosure or short sale standpoint. There's a sign of stress on affordability, but there's no signs of distressed current owners because so many of them have low interest rates. So, you know, all of this is all new dynamics of at least my history in real estate. You know, we've never been in an environment that's had this combination, but if you look at the trends, we are trying to find the bottom on everything that matters to us as real estate agents. And you just got to get through this period of time and be the benefactor of this portion of the curve. These were very, you know, there were some stressful years in here because it was such a low transaction count and there was stressful sellers. Now we're dealing with more probably stressful buyers and stressful sellers, but, you know, we will find a bottom and move higher from here. Anybody have anything they want to interject? All good? Everybody good? So anyway, I'm gonna watch this. I can't wait to see the NAR numbers at the end of the year, but I thought it was a good exercise to look at agent count relative to transaction count. And it's a very it's a predictable, you know, pattern that's happening. And I can tell you, like, I feel positive. You know, I think 2024 will feel like 2023, but I think 2025 and 2026 will be very positive years. So it's like, work hard the next 15 months and you will be the beneficiary of the future years beyond that. So anyway, yay! Is that one more year of this? So,
Awesome.
Anyway, everybody have a great weekend.
Buy stock and ramen noodles.
So, I'll do this again next month for everybody that's around, so. Anyway.
Thanks,
catch
Anton.
up. Weekend.
2.
Bye.
Shoot, shoot.